While you sleep, the mathematical foundation of your local bank is quietly dissolving, and the $400 billion hole in their balance sheet is officially unfixable. It isn't a conspiracy, it's a cold liquidity reality that 186 American banks are desperately trying to hide from their own depositors right now. By the time you see the close sign on the glass door, your digital digits have already been sacrificed to pay someone else's debt. To understand why your money isn't actually yours, we have to look at the invisible architecture of fractional reserve banking. When you deposit $1,000, the bank doesn't put it in a vault, they immediately lend it out, often keeping as little as 0% on hand. This system works perfectly until the Federal Reserve moves the goalposts, raising interest rates faster than any period in the last 4 decades. Banks borrow short from you and lend long to others, locking your cash into 30-year mortgages and 10-year Treasury bonds. When rates spike, the market value of those long-term bonds collapses, leaving banks holding safe assets that are worth pennies on the dollar. This creates unrealized losses, massive financial ghosts that haunt the balance sheet until a single spark forces the bank to sell. In 2023, Silicon Valley Bank became the second largest failure in history because they were forced to turn these ghosts into real losses. They didn't have a bad loan problem. They had a time problem, trying to pay 2026 withdrawals with 2046 bond maturities. Today, the emergency safety net known as the Bank Term Funding Program is gone, leaving regional banks without their favorite crutch. If a bank gets hit with a withdrawal surge today, they can no longer borrow against the face value of their underwater assets. They must sell into a crashing market, realizing losses that instantly wipe out their remaining capital and trigger a terminal spiral. But the bond market is only the first fracture. There is a $1.5 trillion commercial weight about to drop on the system's head. The real shockwave of 2026 isn't in the stock market, it's inside the rotting, empty office towers in the heart of our major cities. Roughly $1.5 trillion in commercial real estate debt is coming due, but the value of these buildings has evaporated by nearly half. When developers can't refinance at today's sky-high interest rates, they simply hand the keys back to the banks and walk away. Suddenly, your local bank isn't just a financial institution, they've become accidental landlords of ghost buildings that nobody wants to rent. This is a double pressure point. The bond losses haven't been filled, and now a wave of property defaults is crashing through the front door. Confidence is the only currency left, but in the digital age, confidence can vanish with a single tap on a smartphone screen. In 2008, a bank run took weeks. Today, it happens in 48 hours via mobile apps and viral social media panic. When the digital stampede starts, uninsured depositors are the first to hit the withdraw button, leaving the system gasping for air. You need to look at the hard data for your bank. Start with the Texas ratio to see if they are swimming in bad debt. If a bank's credit losses exceed its capital buffer, meaning a ratio over 100%, they are effectively standing on a trapdoor. Next, check the Tier 1 capital ratio. This is the bank's armor, and you want it to be thicker than 10% to survive the storm. Don't ignore the ratio of uninsured deposits, as this is the highly combustible fuel that powers a modern digital bank run. The FDIC fund sounds massive at $125 billion, but it covers less than 1% of the total deposits currently sitting in U.S. banks. The entire system operates on the slim hope that we will never all ask for our money back at the exact same time. But as new Basel III regulations force banks to hoard cash, the liquidity in the broader economy is drying up faster than expected. The difference between 2008 and 2026 is that this time, the dominoes aren't falling because of bad people, they're falling because the system's gears are locked. As the Basel III endgame rules take effect, banks are being forced to pile up cash, which means they're effectively shutting down the lending tap. You'll find it harder to get a mortgage or a business loan because banks are prioritizing their own survival over your growth. Sophisticated investors aren't waiting for the evening news. They're quietly diversifying their cash positions across multiple safe havens right now. Diversification doesn't just mean changing banks. It means splitting deposits to stay strictly under the $250,000 insurance limit at every institution. Remember, deposit insurance is a promise, but the process of fulfilling that promise can take weeks or even months of bureaucratic delay. For a small business needing to meet payroll next Tuesday, even a 1-week freeze on their account is a death sentence. This is why high-liquidity assets, like direct Treasury bills or physical gold, are returning to the top of the priority list for those in the know. Don't let the silence in the mainstream media fool you. Those unrealized losses haven't gone anywhere. They are just waiting for a catalyst. Understanding your bank's financial health isn't paranoia. It is basic personal responsibility in a volatile, fast-moving economy. I'm not telling you to panic. I'm telling you to build a personal financial runway that doesn't depend on a single institution's stability. You need to know exactly how many months you can survive if your digital access to funds were to be suddenly interrupted. Knowledge is the only tool that allows you to shift from being a victim of circumstance to being the architect of your own safety. The banking system runs on trust, but your own preparation is what protects your family when that trust is tested by reality. Don't wait for the crowd to stampede for the exit. Check your numbers today before the 2026 script becomes your reality.